Hi everyone, we are discussing certain amendments given by the Finance Act 2015 which are relevant for the May 2016 attempt. Through this slide, I will try to provide certain useful information for students of IPCC as well as CA final who are looking at appearing for the May 16 attempt. I have tried to cover most of the relevant amendments in a very brief and concise manner. If any of you have any specific queries with regards to certain specific sections, you can always get in touch with me on my email, which will be provided at the end of this slide. Let us begin our presentation with respect to the amendments. As always, let us first have a look at the rates of tax. The rates of tax per se remain unchanged for this particular assessment year 16-17. The basic slab rate of 2,50,000 is there. This next slab is from 2,50,000 to 5 lakhs with a rate of 10%, from 5 lakhs to 10 lakhs with a rate of 20%, and about 10 lakhs which goes at a tax rate of 30%. For very senior citizen and senior citizen, there is a change in the basic exemption limit, as we all know. In case of senior citizens, by senior citizens I mean individuals who are 60 years or more of age during the previous year and also a resident. The basic exemption limit has been raised to 3 lakhs. For very senior citizens who are individuals who are 80 years of age or more during the previous year, the limit has been raised from 2,50,000 to 5 lakhs. The other slabs remain the same. Apart from individual assessees, the tax rates for firms are at 30%. For local authority, it is at 30%. For companies which are essentially domestic companies, we have a tax rate of 30%. For foreign companies, on certain income it is 50%, and the normal tax rate that we have for foreign companies is at 40%. So this was all about rates of tax. Let us go ahead to the next slide. Education cess remains same as last year, 2% and 1%. So an aggregate of 3% is what we know. Surcharge provisions have been revisited. I would say surcharge has been increased. So for other than company assessees having a total income in excess of 1 CR, the surcharge has been raised from 10% to 12%. For domestic companies having income in the range of 1 CR to 10 CR, the surcharge has been raised from 5% to 7%, and for income which is in excess of 10 CR, it has been raised from 10% to 12%. There has been no change in the surcharge rates as notified for foreign companies. As we all know, wealth tax has now been abolished. So from an exam viewpoint, it remains to be seen what kind of surprise question comes up in the place of the sure shot wealth tax question that we are so used to expect. Going ahead, let us look at certain changes that have taken place with regards to the section 2, that is the definition section. There has been a notable change in the definition of charitable purpose, which is defined under section 215. As we know, the definition to be, it includes certain specific limbs like education, medical relief, relief of the poor, and then it includes preservation of monuments, etc. And there was also another generic limb included in the definition few years back, which was advancement of any other object of general public utility. The amendment of 2015 now includes yoga as a specific category within the meaning of the term charitable purpose. So it implies that any income which is generated from providing coaching of yoga or conducting classes or any camps, etc. related to yoga and yogic healing will now be exempt, as they will be covered by the meaning of the term charitable purpose. Of course, the exemption will be subject to fulfillment of other conditions as applied to a charitable trust. The other change that we see in this particular definition is with regards to the threshold. For advancement of any other object of general public utility, the threshold in respect of total receipts earned from such activity was earlier placed at 5% of the total receipts of the trust. This has now been increased to 20%. So, if a trust which carries out any other object of general public utility earns income from carrying out of these kind of business activities, which is in excess of 20% of its total income, then that particular activity will not be treated as charitable. Therefore, the exemption will be withdrawn. There have been other changes in the definition section with regards to business, trust, notified, etc., but we are not covering it in this slide. Coming to the next amendment of section 6, that is with regards to residency rule, a new explanation has been inserted in section 6, and it says that For an Indian citizen who is living as a crew member of a foreign bound ship, a manner for prescribing a manner will be soon prescribed for computing the number of days stay in India. As we all know, crew members of Indian ships who were leaving for foreign shores were an exception to the second basic condition. I'm sorry. So, in order to classify these individuals as residents, you always check the first condition, that is, their number of days stay in India was 182 days or more. Now, post this amendment, we will wait for a manner which will soon be notified for determining the computation of number of days stay in respect of individuals being Indian citizens leaving as crew members of foreign bound ships. Next change in the residency rule is pertaining to a company. A company was treated to be a resident if it was an Indian company. So we always went by the logic that an Indian company is always a resident in India. In addition to this, another new condition has been notified. A company which also has its place of effective management in that particular year in India will also be treated as resident. So typically a foreign company, if it fulfills this criteria of its place of effective management being in India in that particular year, it is also going to be treated as a resident. There is not much light yet thrown on what this place of effective management is to be considered as, but we all know that it is a concept which is borrowed from internationally accepted guidelines. It is something which the OECD talks of, and detailed guidelines will soon follow as regards the determination of POEM. The reason for this particular amendment, I would say, is as the residency rule presently is, it facilitates the existence of shell companies in India. So as to say that foreign companies will be treated as residents if their control and management is totally in India. That was what the present rule is. Adding to the difficulty was the situation that what is control or management was not defined by the Act. So there was a scene wherein foreign companies would always have some amount of control or management which took place from abroad, and therefore they used to escape being treated as resident companies, and this would then facilitate shell companies and would lead to some evasion of tax. To actually counter this new concept has been introduced, but it still remains to be seen how exactly its implementation will help the scenario. Talking about an amendment to Section 9, as we all know, in 2012 there was a change which took place in the definition. Not in the definition, in the criteria given by Section 9(1), that is the deeming provision, and indirect transfers also came to be taxable. What was the change of Section 9(1) was typically that if two non-residents located outside India end up transferring a capital asset, and this capital asset predominantly derives its value from an underlying asset located in India, then this would have been considered as an indirect transfer liable to tax in India. This was basically resultant of the Vodafone ruling, and this amendment was retrospective in nature. There was a lot of hue and cry which was caused post this amendment, and a host of indirect transfers in cases similar or akin to Vodafone came under the tax scanner. Looking at the environment around this amendment, what 2015 amendment decides to do is that it says we will give you a threshold, and rather than running after every indirect transfer that we come across, we put a monetary condition, and we will be looking at transfers which are beyond the threshold of this condition. So the first criteria, it says that if the value of Indian assets in such a transaction on the specified date exceeds the amount of 10 crores and it represents 50% of the value of all assets owned by the company or entity, only then such a capital asset transfer transaction will be taxed in India as an indirect transfer. So if your indirect transfer is typically below the threshold specified by this amendment, there will be no tax effect that the entity has to face in India. Some relief, I would say. Next is again a small exclusion in 911 business connection. All overseas investment funds that were located here used to typically have a fund manager present over here. There was a lot of debate as to the presence of fund manager in India, whether it constitutes to business connection or not. The amendment has clarified that if certain conditions are fulfilled, then fund management activity will not constitute as business connection, and the mere presence of a fund manager shall not be sufficient nexus for this entire activity to come within the meaning of the term business connection. There are, of course, a host of conditions that the fund needs to be fulfilled. The same have not been covered in detail in these slides, but if one is interested, they can look at the relevant amendments in the Finance Act. Coming to the next amendment, Section 10. As we all know, Section 10 talks about exempt incomes. The amendments that have been covered here are, I would say, corresponding amendments to certain amendments that have taken place to other sections. For example, under 80C, any amount which you contribute to a Sukanya Samriddhi account scheme has been now made an eligible investment for 80C purposes. The corresponding amendment to Section 10 says that any income which is earned by this Sukanya Samriddhi account scheme will be exempt. Under Section 80G, two new funds have been included in the 100% category, that is the Swachh Bharat Kosh and the Clean Ganga Fund. A corollary of this amendment is that any income earned by these two funds will now be exempt under Section 10. Likewise, specified income of the Core Settlement Guarantee Fund is also going to be exempt under the provisions of Section 10. Next in the line of amendments is a small one relating to Section 11, Charitable Trusts. There was certain level of ambiguity previously with regards to the time limit for furnishing certain particulars that a charitable trust has to in Form number 10. Post the Amendment of Finance Act 2015, it has now been specified that this Form 10 has to be filed before the due date of filing return under Section 139(1) by the charitable trust. Also, there is a condition or a rider which is placed in Section 13(9), and it says that in case if this Form 10 is not submitted on or before the due date of filing return, the benefit of accumulation of income which a charitable trust enjoys will not be available. What is this benefit of accumulation? As we are all aware, for a specified purpose, a trust is entitled to accumulate some part of its income for a period not exceeding 5 years and a grace period of 1 year in addition to that. So if this condition of not filing or not furnishing Form 10 on time is not fulfilled, then this accumulation benefit will not be available, and whatever income or whatever money the trust has set aside for a particular object will become taxable. Return of income, of course, also has to be furnished before the due date. Coming to the next series of amendments, which are a bit more relevant and a bit more important, I would say, from the exam viewpoint. So we first talk about amendments in Chapter 4D, that is PGBP, Business Income, and coming first to Section 32. Section 32, as we all know, talks about depreciation, and the amendment that has taken place here is with respect to additional depreciation. As we all know, additional depreciation is an enhanced benefit given to manufacturing assessees subject to fulfillment of certain conditions. An additional or an enhanced depreciation of 20% of the actual cost of that asset is available to the assessee in the year when this asset is purchased and put to use. As students, we also know that normal depreciation का जो logic है, that same logic is followed by additional depreciation. Or so as to say, the computational norms for normal depreciation apply in toto to additional depreciation. So given a scenario wherein I had purchased an asset and put to use the same for a period of less than 180 days, the rule for normal computation of depreciation mentioned that my depreciation allowance would be restricted to half of what would otherwise be allowed. Going on the same logic, even in respect of additional depreciation, if the asset is acquired in a particular year and put to use in that year for a period which is less than 180 days, instead of the 20% rate which is available to me, my additional depreciation was also restricted to half, or I would say at 10%. There was a lot of discomfort about the other half of this additional depreciation not being allowed to the assessee, since the condition allowing the claim of the same mentioned that it is allowed only once in the lifetime of the asset, particularly in the year in which it is purchased and put to use. With this amendment of 2015 coming in, the amendment now states that if there is certain additional depreciation which the assessee is claiming on an asset which is purchased and put to use for less than 180 days during the year, the balance 50% of the additional depreciation which was not allowed in the year of put to use will now be allowed in the subsequent previous year. So there is this relief that this assessee can claim the balance additional depreciation in the immediately succeeding previous year. A welcome amendment, I would say. Next in the line of amendments pertaining to Chapter 4D is insertion of a new section 32 AD, and here the onset of this section just increases the plethora of deductions that a manufacturer assessee can claim. So we had 32 AC which was introduced last year, we have 32 AD, and both are not mutually exclusive, so one can as well claim 32 AC and 32 AD. So this is all to boost up the Make in India logo or the Make in India concept of this particular government. Let us have a look at what section 32 AD says. 32 AD says that a deduction of 15% of the actual cost of such new asset which is acquired in the previous year in which such asset is installed will be allowed, provided this asset is investment in new plant and machinery and this particular asset is purchased for a business activity or for a business unit which is located in notified backward areas in certain specified states. So we have the states of Bihar, West Bengal, etc. being covered here, and in those states certain areas have been notified as backward areas, and the amendment says that if you purchase new plant and machinery for carrying out your business activity in these specific areas, we will give you an additional deduction of 15% of the actual cost of the investment that you make in this new plant and machinery in the previous year in which such asset is installed. Naturally, there are certain conditions, the predominant one being in respect of restriction on transfer of such new asset. Such asset will not be transferred by the assessee for a period of 5 years. If such an asset is transferred within a period of 5 years as notified, the deduction which is allowed earlier is going to be withdrawn. Meaning of new asset is it should be a new asset, it should not be second hand, it should be installed in the factory or the manufacturing location of the assessee. It should be plant and machinery, it should not be office appliances, etc. So basically whatever conditions are there for claiming additional depreciation, it's a repeat of those conditions for this section. What is interesting to notice, this section is in addition to the depreciation allowance that an assessee gets. It is also in addition to investment allowance under section 32 AC which the assessee can claim. So like I said, it is a plethora of deductions by the insertion of this section. Let us actually try at putting up a question which is a combination of section 32, 32 AC and 32 AD soon. Keep watching this space more for a question that is likely to be put up soon. Next in the line of amendments for chapter 4D is for section 36(1)(3) and 36(1)(7). I would say both these amendments are just taking into account the fact that ICDS, that is Income Computation and Disclosure Standards, have been notified. So for computing business income, instead of wherever the manner as has been prescribed, wherever these subsections used to refer to that, now the text of the ICDS has been included. Section 36(1)(3) was basically for money which was interest which was paid on money borrowed for a asset purchased for business or profession. So that words extension of existing business or profession have been omitted. And 36(1)(7) gave you certain conditions subject to which bad debts was allowed as a deduction. So now they say that the bad debts has been the such debt which is sought to be allowed under 36(1)(7) has been considered in computation of income in accordance with the applicable ICDS. That was all with the amendments pertaining to PGBP. Now let us have a look at the amendments relating to capital gains. A very small amendment here. There has been a lot of schemes of mutual funds which have been consolidated in recent present. So basically unit holders who were holding certain units in one fund now get transferred to the other fund by virtue of this consolidation which takes place, and there was a lot of questions raised as to the tax effect of this particular transaction. There has been relief that has been provided by virtue of this amendment, and it says that there is tax neutrality provided to unit holders. So all those unit holders having certain units of the consolidated fund which have now been consolidating fund which have now been transferred to the consolidated fund, they need not pay capital gains tax on the same. Going further, the amendment also says that period of holding of the units of the consolidating fund will now be included in the period of holding of the consolidated fund. Same goes for cost of acquisition. So we have these amendments as far as capital gains is considered.